Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled Making Sense of Banking as a Service, Recent Applications and Considerations. I'm your host, Julian DeBell. I am a senior associate in Mayor Brown's technology transactions practice. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today are Mayor Brown partners David Beam, Rohith George, and Joe Pinnell. David Beam is a partner in Mayor Brown's Washington, D.C. office and a member of our Financial Services Regulatory and Enforcement Group. David's focus is on payment systems and credit products, with an emphasis on legal issues that arise from the innovative use of technology in financial services. Rohith George is a partner in the technology transactions practice in Mayor Brown's Palo Alto and San Francisco offices. Rohith focuses on helping companies navigate complex commercial arrangements involving mission-critical technologies. Joe Pinnell is a partner in technology transactions and the corporate and securities practices in Mayor Brown's Chicago office. Joe's practice focuses on digital and outsourced services transactions. With that brief introduction, we will now begin today's discussion. David, I want to start by defining the topic of our discussion today. And first, just a terminology point. Banking as a service is typically abbreviated to BaaS and pronounced BaaS, similar to the way software as a service is abbreviated SaaS and pronounced SaaS. So you'll be hearing us refer to it that way throughout the discussion. And when you do, know that we are not talking about fish or fishing. But what are we talking about, David? What is banking as a service?
Julian, banking as a service, the term BaaS, generally refers to what can be thought of as a variation on a traditional bank fintech partner model. I'm sure most listeners on the call are generally familiar with that model. It's taken off in the last 10 years or so, and in it, a fintech company will have a technology platform to provide certain financial services, such as loans or transaction accounts, and they'll want to provide it. They'll have some kind of technology that allows them to provide it in some sort of innovative way. But the fintech company often won't have the licenses or other approvals it needs to offer the financial service component of its platform, i.e. the loan or the account directly. Or sometimes maybe it could offer it directly if it wants to, but there's a regulatory advantage to having a bank offer that product. For example, when making loans, a bank generally won't be subject to state-by-state usury laws, but a fintech would be. So what the fintech in that situation can do is it can set up a partnership with a bank or other financial institution, depending on what kind of product is involved, to provide the financial component of the fintech's platform. That is to make the loan or establish the prepaid or deposit account for the customer, etc. This is usually done on a white or gray label basis. I say gray label basis rather than just only white label basis because oftentimes for various regulatory reasons and other reasons, which we're going to talk about more on the call, it isn't possible to offer a true white labeled banking product through a fintech company. One of the primary reasons is, for example, that the contract terms for the service will generally need to be between the bank and the customer. So the bank is not completely in the background, but it is presented and branded as the fintech's product. And so I call that gray label. Fintech company business models are supposed to be innovative, and in fact, most are. And if the innovation in a fintech model comes from some aspect or feature of the financial product being offered by the bank, then the bank product provided through the arrangement with the fintech will need to be tailored to fit the model in some respect. As a result, platforms to support fintechs and many banks have developed platforms specifically for fit partnerships with fintechs need to be flexible. The bank needs to be able to adapt the products to fit the fintech's model. A BaaS arrangement is similar in principle to everything I just described, but the primary difference is that with a BaaS platform, a bank is offering its products through partnerships with other companies, but it's doing so in a way that is designed to be scalable. The traditional bank fintech partnership model platform has focuses on being customizable, focuses on being flexible to meet the needs of the innovative fintech model. A BaaS platform usually focuses more on scalability, and that means standardization. And it also means that the fintech company or whatever partner is involved is going to interface with the bank through public APIs. This limits customization options. It's still possible to give potential partners a range of choices of different variations of products, but the kind of customization that you often see in a bank fintech partnership isn't generally consistent with the idea of BaaS or the way BaaS arrangements are usually structured. And this is what really in many ways distinguishes it from the traditional bank fintech partnership model. And also partly as a result of the standardization that you typically see with these BaaS platforms, the financial products offered through the BaaS platform often are not the core product offering of the partner. With a bank fintech partnership, often that is the loan or the deposit account. That is the core of what the fintech platform is offering. In contrast, because there's not much innovation in a business model that says we're just going to offer something that everybody else is offering or that anybody else could offer as a standard fare product. Generally, where you see the use case for a BaaS arrangement is to complement some other product of the partner institution or the partner company.
Okay, so you've got banks and BaaS partners, two parties on one side. We know what banks are. Can you give us a sense, Rohit, maybe of who these BaaS partners typically are, the counterparties? What kinds of companies are banks partnering with?
Sure. Building on what David said, I think we've seen bank partnership arrangements for a long time. We've represented both banks and fintechs in these arrangements. For example, where an online lender who provides consumer loans needs to partner with a bank to actually offer the loans. But what's interesting to me about the concept of banking as a service is that it expands beyond these more strategic partnerships into a wider range of BaaS partners. So to provide some examples, I think of the companies that are interested in obtaining banking as a service. I think of them as falling into a couple different categories. First, there's the fintech that wants to integrate a variety of banking services into its platform. So let's say a company that provides automated personal financial advice based on information that it collects from a customer. It may then want to actually allow its customers to establish those financial accounts directly within its app. Not only do you get the financial advice, but you can actually execute on the advice all within the same platform. This company could engage then through BaaS with a variety of different bank partners using the bank partners BaaS platforms in order to make a range of products available to customers. So you can get a recommended loan through one bank. You could open a checking account with another. Perhaps even open a credit card with another. The banks ultimately get more reach for their products. The fintech improves the overall stickiness of their platform, of their product. And so, it's kind of a win-win for both sides. The second category, I think, of companies that are interested, which is much broader, is the larger set of non-financial companies that see financial services as being an opportunity, to improve sales, to deepen their relationship with their own customers. A big talking point over the past couple of years, or the past few years, has been whether and when big tech was going to make its major foray into financial services. And some of that's already started, right? Some of this is happening already. You have big tech offering integrated checking or credit products. But really beyond big tech, I think lots of companies are interested in the ability to integrate financial services into their products. You could have, a home appliance manufacturer that builds instant personal loans into their sales process. You could have, therefore multiple loans that are offered with instant checking against various credit boxes from various banks. You could, alternatively, you could have a supply chain management company that embeds the financing process directly into their platform. So there's a wide range of use cases for all different industries. As David mentioned, these are the kinds of use cases where a BaaS model can be really effective. And the potential upside here, if you're looking at this as from a 1,000-foot view or as from a long-range view, the potential upside here for banks is that they can move from their current more walled garden environments to becoming a key money Lego that that can be built directly into the ecosystems and platforms of online commerce, which I think is really interesting and exciting.
Okay, so really interesting new arrangements between banks and their partners. But Joe, I know one question our bank clients are probably going to be asking themselves at this point is, who's the service provider here? Is the bank the service provider to the BaaS partner or vice versa?
So that's a complicated question with different answers depending on who you're talking to. So I'm obviously a technology contracting lawyer who sees a lot of software as a service or SaaS deals. So the first time I heard the term banking as a service, I thought, this sounds cool. The bank is the as a service provider, just like a SaaS provider or any other as a service provider. And the business team at our banking clients would probably give you the same answer and tell you that banking as a service is inherently the bank acting as a service provider to the tech company or other partner. The bank business team, as David mentioned, views this as an opportunity to build a scalable one-to-many solution that can be rolled out to many BaaS partners in a standardized way and generate revenue for the bank. From this perspective, the bank is acting just like a SaaS provider, just with a different product being sold in an as-a-service model. The more complicated, but probably more correct answer to Julian's question, depending on the circumstances of the deal, is that both parties may be service providers to one another. The bank is supplying banking services to the BaaS partner and its customers, and the BaaS partner is supplying the bank with a technology platform that's used to deliver the bank services to the end customers. So from a contracting and incentives perspective, it's not always going to be a neat and clean, we are the service provider or we are the service recipient scenario that commonly occurs in a traditional outsourcing SaaS or bank fintech platform licensing arrangement. Sometimes people on the business team won't like this answer because they think that if the BaaS partner is the service provider to the bank, then it will trigger a lot of regulatory hurdles. They think that calling the tech company a quote-unquote partner instead of a service provider would allow them to avoid those regulatory hurdles. The reality, as I understand it, is that a lot of the relevant guidance from the OCC and other regulators governs any third-party relationship with a bank, not just relationships with companies that are called a vendor or called a service provider. So the nomenclature doesn't matter too much from a regulatory perspective, but David may have additional thoughts on that as an actual bank regulatory lawyer.
Well, Joe, it's funny that you say that when you first heard the term banking as a service, your reaction as a tech lawyer is that's cool. They're doing SaaS with banking. My reaction as a banking regulatory lawyer was, hey, what do they think of next? Hamburger is a food? What would banking be but a service? And I think that gets to the question you're talking about as to who's a service provider to whom. Put the emphasis, I'd say, on whom. Banking is always a service, and when a bank provides a banking product through a BaaS arrangement, it is a service provider, but the critical question is to whom is it providing the service? And in most arrangements, largely for regulatory reasons, it has to be this way. The bank has a direct contractual relationship with the end user, which is ultimately the customer of the partner to the bank. And they are providing that service directly to that customer. So they are a service provider, but in many respects, they're a service provider to the end user with respect to the banking services anyway. It might be, from a commercial sense, a service provider relationship in the sense that the bank, by providing this service to the end user of the partner, is providing a benefit to the partner, and thus it is a service in that sense. But really, the primary customer of the bank oftentimes is going to be the end user customer of the BaaS partner arrangement. As you point out, though, a lot of this question for regulatory purposes could be a red herring in some respects, because the third-party risk management guidance, which used to put a lot of emphasis on the category of vendor or service provider, has migrated away from that in recent years. And it's done so in part because it can be oftentimes a conceptually difficult question to answer whether somebody is a service provider or if this is some other type of relationship. And the bank regulator guidance as it exists today, in some ways, sidesteps the analytical question of should we put the label service provider on the bank or on the third party, i.e. the BaaS platform or the BaaS partner to the bank. And it really just gets to first principles and focuses what are the risks in this arrangement to the bank? How could non-performance or other misconduct by the third party, the BaaS partner, cause harm to the bank? And that's what the bank has to identify. And that's what the bank's responsibility is to address and to mitigate in appropriate ways through various methods, whether it be through the structure of the program or through its contracts with the BaaS partner. So ultimately, under the third-party risk management principles, you don't even need to get to the question of who is the service provider per se. That assumes that if you're the lawyer representing the bank, you have your third-party risk management program for the institution that you represent actually gives you the luxury of sidestepping the labeling question. Many of these programs still explicitly distinguish between service providers and other third-party relationships, and there's good reason for doing that. It's still a good analytical tool in many respects.
Okay, so as David, as you and Joe have explained, we're kind of in uncharted territory here where we can't really rely on these traditional concepts of service provider and service recipient. What then are the implications of that for the structure of the deal and the contract? How are these arrangements set up contractually, Rohit?
Yeah, so the key contractual implication is that you can't simply pull out a SaaS agreement template or an outsourcing agreement template and fill in the bank as the service provider or the bank as the customer. So the bank, while offering a service to the BaaS partner, is offering, as Joe and David just mentioned, is also offering services to end customers to the relationship. And while the BaaS partner is essentially procuring critical services from the bank, it's also performing key functions on the bank, like for the bank, like handling complaints, transmitting disclosures, et cetera. So, at the end of the day, the contracts, therefore need to clearly segregate roles and responsibilities, particularly vis-a-vis the customer, without regard to these titles of service provider or vendor or customer. They need to identify things like who has the ability to determine and modify end customer agreements, what elements of customer service are within the bank's purview versus the BaaS partners, and so on. So I think we'll discuss in more detail a little bit later on.
Okay, and so obviously that segregation of roles and responsibilities, that allocation needs to align with regulatory expectations. But David, from a regulatory perspective, is it always going to be black and white how those responsibilities are divided up?
Unfortunately, it isn't. And sometimes even more than from a regulatory perspective, you can get a lot of disagreement among the parties as to what role somebody is acting in with respect to any activity under the arrangement, and thus what terms should apply with respect to that activity. And in particular, the more integrated a BaaS product is with the other partners or the partner's product and services, the more difficult I think it can be to isolate which activities are activities of the partner done on behalf of the bank, done as a service provider for the bank, if you will, and which are done on its own behalf in connection with its separate relationship with the end user customer. For example, this can come up when you start to negotiate data usage rights. The bank generally will want to, and to some extent it may be required by privacy laws, to restrict contractually what the partner may do with customer information that the partner acquires in the course of acting as a service provider for the bank. The bank is going to, dictate in the contract the purposes for which the partner may use that information, with whom it may share that information, etc. When a BaaS solution is deeply embedded in the partner's platform, you can encounter a lot of situations where the parties disagree over the capacity in which the partner acquired various information about the customer. For example, if the BaaS product is an embedded payment solution where it provides credit or otherwise facilitates payment at checkout and is integrated into the BaaS partner's digital or online checkout process, then isolating what information that the partner acquires in connection with that transaction, in particular with the checkout process, should be considered subject to the bank's contractual restrictions on customer financial data. It can be very challenging, and it can lead to a lot of debates. For example, is the information that the customer provided and that is used to affect both the BaaS solution and the transaction as a whole, and these can include data points like the name, address, etc., something that should be subject to these restrictions. Is that data that was acquired by the BaaS partner in connection with providing the services to the bank, or is it data that the BaaS partner acquired in connection with its own transaction with the customer? The answer is both, but one of the things that the BaaS partner is likely to point out is it would have captured this information even if the customer hadn't used the BaaS solution. Another data point that could oftentimes be fall into a gray area, and that can be a source of contention, is the fact that the customer chose to use the BaaS solution at all. That data point might be useful for various analytic purposes for the BaaS partner. And should that fact, the fact that the customer chose to pay with the BaaS platform, be considered part of the customer data of the bank that's subject to the restrictions the bank imposes on the use or disclosure of its customer data? Or is that transaction data of the BaaS partner? And what about the fact that the customer chose not to use the BaaS solution? If that data point is associated with the customer, is that itself considered something that relates to the BaaS product or service? And you could go on and on. You could ask, what about a situation where it's not a binary question of whether they used BaaS or not, but whether it's just a point, whether the partner just captures the payment solution that the person used and uses that for analytic purposes. But the real key here is that these transactions can be very integrated. It can be very difficult to separate out what data points are appropriately viewed as bank data point or bank customer data for regulatory or other purposes from the data points that the partner acquires through the course of its own transactions with the customer. And remember, tech companies thrive on data, and they may find value in data that seems just completely banal to others and utterly uninteresting. And so there could be some contentious negotiations around some pretty seemingly basic data points.
So yeah, who owns the data, right? But related to that, and maybe the more critical question is, who owns the customer relationship in a banking as a service arrangement? Is it the bank or the BaaS partner?
I'll grab that one, Julian. So the short answer is that the BaaS partner owns the customer relationship in most BaaS arrangements. The BaaS partner's platform is the primary channel for interacting with the customer, so this is a logical result in many ways. The longer answer is that ownership of the customer relationship is a complex concept with several components, and the allocation of those components between the parties will be product and deal specific. So what are those customer ownership components? We don't have time to get into all of them, but some of the bigger ones are servicing, exclusivity, cross-marketing rights, and rights upon termination. As a general rule, the BaaS partner is responsible for servicing the customer relationship, even in connection with financial products and services. The BaaS partner will provide the user interface, first-level customer support, and delivery of disclosures and other customer communications. Banks will insist on handling some servicing functions directly when there are nuanced regulatory requirements to comply with. For example, it's common in the consumer context for the bank to take responsibility for resolving customer claims regarding disputed transactions. The next customer ownership component I mentioned is exclusivity. Since BaaS is intended to be an as-a-service, one-to-many model, the bank will generally not agree to exclusivity with any particular technology partner. They ideally want to replicate this arrangement with many other BaaS partners to generate more revenue. In the other direction, if the bank has substantial leverage, it might be able to negotiate a prohibition on the BaaS partner selling competing products and services from other financial institutions to its end customers. Depending on where the parties land on exclusivity, a related customer ownership component is the right to cross-market other products and services to the end customer. In many cases, the bank may have limited rights to cross-market additional products to the end customers outside of the BaaS program. Conversely, the BaaS partner may retain full rights to cross-market other products or even reallocate the delivery of products and services to other banks in real time. For example, in a payment processing arrangement, the BaaS partner may retain the ability to route transactions to different financial institutions on a transaction-by-transaction basis. On the other hand, if the deposit of funds of the bank is required to facilitate transactions, the program agreement terms may give the BaaS partner less flexibility to unilaterally transition customers from one bank to another. The last component of owning the customer relationship I should mention is what happens at termination or expiration of the BaaS program agreement. If the BaaS partner has multiple bank partners, like in that payment processing example, they may simply start routing transactions to those other bank partners. If the bank will be the exclusive provider of the relevant financial products to the customers during the term, then there may be disengagement services provisions that require the bank to smoothly transition delivery of those products to the BaaS partner's new financial institution.
One thing to note, at the risk of stating the obvious, is that the concept of who owns the customer relationship as a commercial matter should be kept distinct from the question of whether the person is a customer of the bank for various regulatory purposes. And this includes regulatory purposes where the applicable law actually uses the term customer. And two examples are the FinCEN regulations implementing the Bank Secrecy Act and other anti-money laundering laws, which basically define a customer of the bank as someone who's entered into a formal banking relationship. And when somebody is a customer of the bank, as defined in FinCEN rules, that trips a number of regulatory requirements, including customer identification requirements and know your customer requirements. If the person is a customer as defined in the FinCEN rules, those requirements are going to apply, and the bank is going to have to comply with them, regardless of whether as a commercial matter the parties regard the end user, the customer, as primarily the customer of the BaaS partner. Another example is that many privacy laws refer to customers of the financial institution, and the end user oftentimes will be customers for purposes of those laws. But even beyond laws that use the specific term customer, it's important to remember that regardless of how the parties allocate the contractual rights that collectively comprise the concept of ownership of the customer relationship as a commercial matter, at the end of the day, the bank is generally going to have a terms of service with the customer. It's generally going to be providing those banking services to the customer, and as a result, it is going to have obligations to that customer, both as a regulatory matter and as a contractual matter. And these are going to exist simply because the person has a contractual relationship with the bank, is in contractual privity with the bank, and exist independently of how, as a commercial matter, the parties think about who the end user is the customer of.
Okay, so what are some of other challenges for banks as they set up these banking as a service arrangements? Rohit?
Yeah, I think we've touched on a number of the legal issues that pop up in these arrangements. One of the more high-level challenges for a bank is how to build a scalable product in this space. And as I mentioned earlier, we've been helping banks and fintechs, negotiate traditional bank partner agreements for a while now. While some banks have had starting templates and forms, many of these were bespoke agreements that were designed specifically for the strategic opportunity that was presented at that time. Here, the bank is looking to build a product offering that it can scale to potentially and hopefully many BaaS partners. If you ask any fintech, what it means to be scalable from a contractual perspective, they'll tell you that means they need to have a short, simple contract that's easy to negotiate and manage. Easy to say, harder to do, especially for a highly regulated institution. I don't think I'll hurt anyone's feelings by saying that bank contracts and templates are rarely short and simple, but that's part of the challenge. Once you've built the technical capabilities, the APIs, the core infrastructure, the core banking software, in order to enable kind of the integrated BaaS solution that you want to develop and offer to the market, how can you then safely streamline the onboarding process? How can you think like a platform provider while still meeting the regulatory obligations of the bank?
And one of the major factors to consider when you're thinking about how you can scale your BaaS platform is how you will meet your due diligence obligation under third-party risk management guidelines with respect to the platform. Those guidelines do require banks to perform an appropriate level of due diligence of potential third parties with which the banks are considering entering into arrangements of all types. And that due diligence needs to be tailored to the nature of the arrangement, in particular, the nature of the risks it presents. And in that regard, what kind of due diligence you need to perform on a partner in a BaaS program is going to depend a lot on what products are involved and how the arrangement is going to be set up. Generally, at the risk of oversimplifying a complex process, the way I generally think about it is that you should start by thinking about all the ways a BaaS partner could expose the bank to legal or reputational risk or other type of risk or injury. Basically, this amounts to think about all the ways that the BaaS partner could screw something up that would result in harm to the bank. Then you develop your due diligence program accordingly. And there's a symbiotic relationship here between the level of due diligence required and the extent to which you will be depending on the partner for compliance or other critical purposes. The more critical functions from a compliance and operational perspective that you keep under your own roof, so to speak, with respect to your BaaS platform, in principle, the less risk is presented to you by the relationship with the BaaS partner. And you can tailor your due diligence program accordingly. One of the key differences between due diligence in a kind of a scalable BaaS platform arrangement or any type of scalable arrangement like that and bespoke third-party deals is that in the latter, the due diligence is about much more than the binary question of whether to deal or not to deal, whether to enter into the arrangement or not. Another critical goal of due diligence is to get a refined view of the partner's strengths and weaknesses and how this can impact various parts of how various parts of the deal are structured. Depending on how your BaaS program is set up, the due diligence process might, in fact, be more of the deal or no deal variety. If the allocation of responsibility for various aspects of the program and the oversight process that the bank will employ to monitor the BaaS partner are all baked into the BaaS platform and standard across relationships, as in there's a way with the platform that you allocate responsibility for compliance and other matters, and there is a very defined way that you exercise oversight over the partners, then your due diligence is probably going to involve mostly setting minimum standards that a partner must meet in light of that framework, and then verifying that the partner does in fact meet those standards. On the other hand, if your platform supports more flexibility in terms of allocating responsibility for critical functions or in how you oversee the partner, then, or in other critical aspects of risk management, then your due diligence process will probably be directed also at evaluating which tranche, if you will, the partner belongs in for these purposes. That is, whether or not you're going to put them in a tranche where they are able to which you will allocate more responsibility to them, or which you might have a lighter or heavier, depending on the tranche, oversight process for that particular partner.
Okay, so these are all concerns from the bank's perspective. What about from the BaaS partners' perspective? What are the challenges for them, Joe?
Well, we've run through a lot of them already, Julian, but I think there are a number of challenging issues from the BaaS partner's perspective. First, the BaaS partner has a platform and a customer experience that it will be highly protective of, and they'll want to have rights to change and evolve their platform with as little interference as possible from the bank. The bank obviously has an incentive to negotiate input and approval rights over things that will impact the customer experience or either party's compliance with laws. The BaaS partner will also want flexibility to market the financial products and services through their existing sales and distribution channels. And obviously, the bank will negotiate hard to maintain input and approval rights over those marketing efforts from a quality control and branding perspective, if the bank's branding will be featured. The BaaS partner will also be keen to preserve options to use other bank providers and to terminate the relationship if the bank isn't meeting its obligations. The BaaS partner won't want to be wedded to offering products of a particular bank if that bank is underperforming, and they'll want rights to a smooth exit both for the BaaS partner itself and its customers if the agreement is terminated. Obviously, intellectual property can be important from both parties' perspectives. The BaaS partner will want to retain ownership of any changes to its platform in relation to the program, with the exception of things like the bank's trademarks and branding, assuming it isn't an entirely gray label arrangement, as David described earlier. Data is generally not protected by intellectual property rights in the United States and in many other jurisdictions, but as David mentioned earlier, both parties will be keenly interested in allocating rights and restrictions regarding their usage of data exchanged or created under the program. This often goes hand in hand with the ownership of the customer relationship points I touched on earlier.
That's a great summary, Joe. Thank you. Thank you, Rohit. Thank you, David. And thank you to our audience for tuning in. A few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.